Hi, this is Sam. Welcome to this live webinar where we're looking at when do expats need to do a UK or a Cyprus return. The simple answer is one thing, the complicated answer is another. And so let's consider what these mean. If you're a tax resident, of course you need to do a return, and that is an issue that needs to be raised for expats that live and work abroad. Are you actually residents in that location? And it's different. So if you're from the UK, say, your domicile defines your tie to your origin of where you come from. Your domicile could be American, Canadian, Spanish, Portuguese, Cypriot, Australian. So what your domicile is determines to a degree what your tax residence is. So you need to have a look at that, and it determines about how many days you can spend in the country. So in this series of live webinars, we'll look at that, what's defined as domicile and residence, and whether you need to do a return on that basis or not. Expats going into and out of the UK can do a split year treatment, but only every so often. So there has to be at least 3 full tax years between those different changing dates. So these are all things that need to be considered by an expat on deciding whether they need a tax return for that year. The split year is a great system in the UK because it allows you to have 2 years, 2 tax years in one tax period, whether that's a calendar tax year or more like the UK tax year, which is April to April. Now, why is the UK tax year different? Well, because it's based upon the old former Roman calendar, which dated from Easter being the start of the new year. Whereas most countries around the world these days use a calendar year for their tax year. So there are some variations on that. And when their tax returns are due, it varies for that. So an expat living in Cyprus is working under an annual tax return, a calendar tax year, and so the return becomes due after the first of the month, 1st of January, 22 for 2021. However, it needs to be made available online, and in Cyprus that should happen generally in a pre-COVID world by the end of January, but in practice it might be the end of March or even into April before that is made available. The returns are technically due by the end of April in Cyprus if you need to make one. But again, the last couple of years, that deadline has been extended into September, October, November, December the following year. So you've got a whole year to do your return from the previous year. But that system is based upon the fact that you've already paid your tax that's due. So when we look at these taxes that are due, it might be that you've got taxes to pay for 2022 that you need to pay this year. It's the same system in the UK. So once you're on a self-assessment system as an expat, you have got a liability to do a return and make twice yearly tax payments in July and January, with any balancing payments for the previous year being in that January. So there is a system for collecting the forward taxes there. In the UK, a lot of taxes are also taxed at source. So those taxes are settled up if there's a rebate or an additional payment from the tax return that's done by the expat at the end of the year. So those are the timing issues. So a UK expat has got additional constraints because of their domicile to the UK about when they need to do a return and when they become resident. An expat living in another country, it's a clearer situation. So in Cyprus, the way they count tax residence is your days in the country. You only have to be in the country for 60 days to be a tax resident for a current year as an expat. So if you're nomad or investor, crypto-based investment, you're moving around the world, you only need to be based in Cyprus for 60 days, a resident in Cyprus for 60 days in that tax year, which is the calendar year. Bearing in mind, on the other side of the thing, to be tax resident, you've got to have a permanent home in Cyprus. So you have to maintain a home and a residence in Cyprus, even though you only occupy it for 60 days. That can work for a family of an expat that's based while you're working abroad in the Middle East or Asia, or just traveling around, nomad. So you've got that financial commitment to the home in Cyprus, but you only need to be here for 60 days. So that could be quite attractive. And when you've got that nomad existence, a nomad in Cyprus has got the option that if their earnings are below 100,000 euros a year, they only pay 50% tax. So that's another consideration, a way of saving tax. As a nomad in Cyprus, you can pay half the amount that you would do in if you were tax resident in permanently in Cyprus. If all your earnings are abroad and you're not domiciled to Cyprus, you may still need to do a return, but on a remittance basis, you might not need to pay any tax on that overseas earnings. That doesn't mean that you don't pay it at source. And that's, again, about the contract that you've got and the working arrangements that you have. And we said in our previous webinars, if you split up your income between a family trust and a family business and an individual, those tax residents can be in different jurisdictions, and you can use the different allowances and rules to better serve you as a tax client. So that's something to consider. In the UK, there are fixed incomes. So if you've got the big changes in 2021 were with property tax. So a capital gains tax have been brought in effectively on all properties, including commercial properties. So you can't avoid some form of capital gains tax assessment. Obviously, if the property is owned by a corporation, the tax is corporation tax at 19%. If it's owned by an individual, then the capital gains tax on that property is up to 28%. So it's 18 or 28%. So it's higher. Now, the big change that came about in 2021 is that the tax return for any sale before the end of October, 27th of October 21, the capital gains tax report was supposed to be within 30 days and the tax paid. That's been extended to 60 days. So any sale after the 27th of October 2021 is a 60-day requirement. So even so, that should have been submitted by the end of December, and any capital gains tax paid by the end of December 2021. But still now, any expat or UK resident selling property in the UK has got a tax return to do within 60 days of that disposal and pay the capital gains tax. And in addition, that capital gain has to be reported on the April 2022 tax return for the 21-22 UK tax year. So there's quite a significant amount of changes. There could be an overdue liability on the capital gains tax. The other big thing for expats is that there is no deferment relief on property capital gains tax, UK property capital gains tax. So whereas an expat can sell a UK-based investment, crypto or business asset or valuable, and defer the capital gains tax for up to 5 years, that is no longer possible with property. The tax return has to be done and the tax has to be paid within 60 days. capital, there was some resetting of the values. So although there's no indexing in the UK, they've reset the capital gains tax dates. So to review that situation and what your liability is if you dispose of property, then contact us at proactpartnership.com. If an expat moves a UK property into a corporation to reduce the future capital gains tax liability, again, there's a capital gains tax assessment on that as well. So talk to us about that at a free review. You can chat with us live at proactpartnership.co.uk or contact us at proactpartnership.com. UK have a lot of taxes at source, and generally if you've got pay as you earn, you've got no additional liability in the UK. But an expat with additional fixed income in the UK, such as property rental income or property capital gains, or if the contract is arising from the UK, will have an obligation and a requirement to fill out a self-assessment return. Any UK expat going expat for the first time is generally required to complete a tax return for 2 or 3 years until the UK HMRC confirm that they no longer want to return. The obligation then is only to complete a UK return if you've got any liability. So when you go expat from the UK, you could have a return that you need to do, but those return obligations might be for 2 or 3 years. And if you've got no apparent income or residence liability in the UK to your worldwide income, you could get exempted from that HMRC tax. We can ask for that and we can negotiate with the HMRC to try and bring that forward or do those returns for you. Contact us at proactpartnership.co.uk. UK taxes, the basic rate is 20% and the personal allowance is 12.5%. So for expats abroad, if they've got a shared ownership of a property with property rental income, even though they do that tax return, they may still have no tax to pay. The return has to be done. Property agents in the UK deduct tax at source. You may want to do a UK return to get exempt relief as a non-resident landlord. And again, we can help you with that tax registration. So it gets quite complicated. Now, UK do have taxes up to 45% over 150,000 a year. Up to 50,000, it's only 20%. So flipping back to Cyprus now, where you compare that, it's quite an attractive location because they'll only tax you if you're doing the 60-day or the nomad, or your business is outside Cyprus. Then it could be possible that they're only taxing you on your income in Cyprus, or they're giving you a 50% tax rate on your earned income. So there's lots of quite attractive options with Cyprus. But the other thing is to have a high personal tax rate where there's zero tax. But that's €19,500, which is about £17,000. But then, so you can earn 5,000 more before tax in Cyprus than you can against a personal allowance in the UK, and then the rate is 20%. However, in Cyprus, the bands go up a lot quicker. So by the time that you're earning £54,000, €60,000, you're paying 35% tax in the UK, in Cyprus. So up to €50,000, which is about 55,000. So up to £50,000, which is about €55,000, you're only paying 20% tax in the UK. So there's a midpoint in the middle where you can actually be paying lower tax, income tax, than you in the UK than you would be in Cyprus, where you'd be paying 20, 30, 35%. So that's something to consider if you've got the ability with companies and property to manage your income so that you can keep your Cyprus income and your UK income to maximise your personal allowances on that. And then you've got corporation tax. So that's a flat rate tax, which means that it's not going to go up to 30, 35, 40, 45%. So corporation tax for UK is 19% and Cyprus is 20%. So that's another attraction for that. We talked about the flat rate taxes for the UK, not the flat rate taxes, the fixed income taxes for property rental or for capital gains in the UK. There are flat rate taxes in Cyprus as well. Now, for expats, there's a non-domicile status which exempts you from dividend tax at 17% or corporation or dividend taxes or interest tax at 30%, and they're quite high, but they don't exempt you from a flat rate health tax. So health tax is now due in Cyprus from 2.6%, but sole traders would have 4%. So if you're a sole trader or a company and your economic activity is based in Cyprus, you have to register for social insurance to do your tax return in Cyprus, and you have to pay the health tax as part of that. If you're an expat without that liability, then you have a potential liability to health tax as a flat rate tax, even if you're not paying any income tax. Now, for that, an expat can register as non-domicile, but if you don't, or if you don't qualify as non-domicile, then you would have to be paying that 2.6% in your tax return each year. And again, that is part of the Cyprus tax return. So you don't need to do a Cyprus tax return if you haven't got an income tax liability, but if you've got other tax liabilities, you need to pay those taxes and potentially submit those returns as well. So it's slightly more complicated. Then the residency rules work slightly different in Cyprus as well. So on the day in, you're counted as you can be counted as resident. On the day out, you won't be counted as resident. So it varies. So not a midnight rule as such. So the day you arrive is a day in the country. The day you depart is not a day in the country. And it's slightly different if you're in and out on the same day. It either counts or it doesn't, depending whether you leave and come back or you go out and come back. So what going out and coming back is not in country. So you can identify what your tax residence is for the year. So those are some of the key criteria. So if you haven't got an exemption to health taxes, that is also connected to Brexit. So if you are a UK expat with EU residency or an EU expat at any time, even new from now, and you've got pension status, the reciprocal health service agreement allows you to be exempt from the health taxes. New British expats won't get that because the UK from the end of Brexit are no longer a member of the reciprocal social and pension benefit exchange scheme. So you get tax relief on your pension, but you might still have a liability to the health tax in Cyprus, even as a pensioner. If you've got EU residency pre-Brexit, pre-2020, even if your pension is 5, 10, 20 years ahead, you will still get the exemption from the health tax, and you'll still get the potential S1 between the UK and Cyprus or the other EU country that you're in, as long as you've got your EU residency permit pre-Brexit, okay? If not, you've got a health tax liability to pay and potentially to declare on a return. There is another big change coming in from 2022 for UK. And again, we'll go into this in more detail during this series in March and April. The changes to the requirements for inheritance tax returns. Now, this affects expats. If an expat is domiciled in the UK, if you're from the UK, you've got a liability to inheritance tax on your worldwide income. If you're not domiciled to the UK, you've still got a liability to UK inheritance tax when you die on your UK assets. So if you've got a villa and you're forced to sell it through whatever reason, given the current political situation, then potentially that's a capital gains tax assessment for you. If you die, that's a potential inheritance tax liability as well. So capital gains tax liability is up to 28%, inheritance tax up to 40%. So £1 million apartment in London could leave you open to that as an inheritance tax. Now the rules have changed for expats, which will help something. Up until 2022, there is no, everyone had to do an inheritance tax return on their estate. From January 22, that has changed. There's no longer a requirement in certain circumstances. So if everything is being left to a spouse or civil partner within the family, then there's no obligation to fill out the inheritance tax return because there's no liability. If the money is being left to, is below 650,000, that is the liability between husband and wives. Again, that exemption to do that return is lifted. And there's also rules and allowances. It depends upon how much the value of the estate is about whether the return is needed on first death as opposed to on second death. So there are some exceptions now where an expat owning property in the UK doesn't necessarily need to do an inheritance tax return. If you do, then we can help you with that. If you have a potential liability in the UK, then you need to consider making a will, which again, PROACT can help you with that UK, Cyprus or international will. And beyond that, you need to consider in more detail whether you would consider holding your assets in a trust, family trust, where you can control that, avoid the cost and delay of probate. But avoiding probate means you've got no inheritance tax assessment. So UK assets can avoid 40% capital gains tax, either by paying a lower capital gains tax sooner to move the money into trust, or potentially by gifting over a long period of time to avoid that tax liability. So inheritance tax returns on death can be avoided now. Otherwise, they're compulsory for all deaths up to the end of 2021. But from January 22, there are some exceptions. For more guidance and advice, we offer free reviews. Contact us at proactpartnership.com to look at that. So I hope that's given some guidance about when you need to do a return. So the UK returns will come online after the 6th of April, and anybody who's received a notice for a self-assessment will need to complete that. That will include all expats with property rental income, even if tax is paid at source, and any expat with UK income arising that needs that return. If you need a split year return, that is one way of dealing with a sort of split year application to protect worldwide earnings and overseas property sales and capital gains. There's lots of exemptions and options that expats can use in Cyprus, Portugal and other jurisdictions, as well as the UK, to maximise their allowances and save tax using family business and family trusts. And if you want help and guidance on that, contact us at proactpartnership.com. We've got a couple of questions now, and as you can see during this, I need to go to the glasses for that. And then afterwards, you can join us at our Facebook group, where we've got a Q&A for our retained clients. So if you're a retained client, go to the Facebook group for a live question and answer session if you want questions there, and also to see another version of the webinar for that. So we'll be sharing out information on this, and we're looking at more detail in the coming days and weeks. Stay in touch with us, and if you want a free review or to register with our retained client service, contact us at proactpartnership.com. or you can book a free review online directly at projektpartnership.co.uk. Thanks for listening, and we'll see you again next time.